2025 continues to be a crazy year in the markets. Look at gold up yet again 1.68% here on the day. Gold is hitting a fresh all-time high at $2,900 an ounce. And this is the crazy part about markets is not only is it up a ton today, well, it's been up a ton recently. And you just got to think that a lot of people who are trying to fight trends right now, who are short gold, are probably really kicking themselves. And it's a very repeatable function that we see over and over in markets. People who see these things go up a ton, they say, gold's got to come down, gold's got to come down. And yet time and time again, when really strong trends take place, they can go a lot further than market participants think. At the same time, we've got the NASDAQ ripping up 1.4% here this morning. And you've got oil also making a little bit of a bounce back. You've got the dollar index holding steady and much, much more. We're going to talk about setups that I'm looking at right now in the markets just after this. So as we get started in today's video, I do want to just remind everybody, if you have not already joined our free Telegram channel, we're dropping bonus clips from the live streams and from our content here inside of our Telegram channel throughout the week. If you want to make sure you get up to date with our chart of the day videos, we're dropping them each and every day inside of the Telegram channel. Completely free to join. Link is in the description. So there's so many places we could start, but I do want to talk about the topic of the day. Gold ripping up 1.7%. What is going on with this thing? And what is going to get this thing to cool off? I know there's a lot of traders who are probably short gold who are, trying not to cry right now as this thing continues to rip through highs. But I do want to just reiterate that, again, as we started out this video talking about, trends can go so much further than people think. And this is why, especially if you're fighting trends, you really need to take a good look at what you're doing and reevaluate. Be careful, because while being counter trend can sometimes work, it is very difficult to get the timing right when you're trying to fight something like this. In fact, my opinion on this is the path of least resistance for gold is higher, not lower. A lot of people would think, oh, after a big move like this, it's got to pull back. But the problem is people have been thinking that since way over here and way over here and way over here, thinking that, oh, gold has got to reverse here. In fact, that's been the story for multiple years now. A lot of people on social media, I'm not naming any names, have been constantly battering and yelling at the top of their lungs, short gold, it's going down, it's overbought, the fools are buying this. And yet again, once more, we are at a new fresh all-time high, a staggering, nauseating, blinding level of new heights, 2,900. I can hardly breathe up here. The air is starting to thin out. It's like we're at the top of Everest at this point. Or are we? Are we just starting to reach the top of Everest? That's the thing about this. Again, if I'm looking at gold, I'm not someone who's going to go out there and say, oh yeah, this is overbought, I've got to short this thing because it's certainly going to go down from here, because we could see gold continue up to 3,000. We might be going straight to 3,000 right now. Now, again, some people would love that. Some people would hate that. That's the way markets work. My personal opinion is I love the bull case for gold right now, much more than I did a few weeks ago. In fact, my system here is actually showing some very bullish readings for gold and continues to do so. So last week, early in the week, we got a signal from the Edge Finder, official bullish reading on the Edge Finder. And again, at the time that looked kind of crazy. Gold's already gone up a ton. Well, again, a 1.7% gain here today later. And this actually ended up being a great, or continues to be a great idea, in my opinion, for looking for gold bullish setups. So how do we actually take this gold reading on the Edge Finder? Well, for me, what this means is, okay, bullish here, great, but I've got to see if I can get a pullback to this 38.2%. And that seems so far away. That's a drop here for the price of gold of about 4%, which, although sounds kind of crazy, remember that gold's movements to the downside can be very aggressive too. The 9% drop over here, this was a 4% drop right here. Here was what, a 5%? Yeah, 5.25% drop. So you do get these periodically for gold. So while I don't necessarily think that that is what has to happen right now, that's what it would take for me to actually enter into a long position on gold. What is actually setting up a little bit more reasonably for me is silver. Silver, although, similar to gold, does not trade exactly one-to-one. And so silver has had a nice little pop here recently too, but not nearly as much as gold. And I actually think that this pullback to 38.2%, we could see pretty reasonably. In this case, that is a drop for gold of just about 2%. So instead of 4, we're looking for 2, and silver does typically move on average more than gold per day in terms of a percentage form. So it's very possible that we could see a pullback on silver to this 38.2. I like two setups for silver. I like the 38.2 and the 61.8 as possible levels to pick up a long trade. In fact, on the Edge Finder, this is actually getting a more bullish reading than gold with a score of +8. It's telling us that the commitment of traders data looks good for silver, and many of our other metrics that we're looking at continue to favor silver. By the way, if you'd like to try out the software that I'm using, trials can be found down below in the description. You can sign up and apply for one. Using that link, just fill out some information about yourself and your trading style, and someone from our team will reach out with some information about how you can try out the Edge Finder for 30 days. Next up, I want to talk a moment about the indices. So S&P 500, we've got a daily chart pulled up, and you can see that although we've had many, kind of jumps in both directions, the overall direction for the S&P is pretty flat. In fact, we're trading right now at the same level as we were trading. Let's do a little bit of a test here. December 4th. I mean, so for the last 2 months, although we've had some violent moves up and violent moves down, we're actually very flat on the S&P 500 and the NASDAQ for that matter. So both of these markets have been very flat. I'm looking for a pretty clear and simple signal, either a breakout to the upside if we do go bullish, in which case I'd be looking for pullbacks as long as I get some Edge Finder confirmations to go with this, or a deeper retracement back down to the lows here. That also could be interesting and can happen very quickly. Again, you can see how these moves, that's a 6% drop that we saw. A 6% drop from here would bring us down to, this previous low here that we saw January 13th. So I wouldn't be surprised if we do get a little bit of a pullback in the indices, but I am certainly not bearish on them. I'm just kind of very neutral on indices at this time. I do, of course, love the long-term case for stocks. I pretty much always am bullish somewhere in the stock market. But right now, I think I'm better off just staying a little cash heavy and waiting for a dip rather than chasing this thing. Because yes, you may get the runaway breakout. And if that happens, I'll be a little bummed that I missed it like I did with gold. But such is trading. I'd rather wait for the right setup and know that the trade I'm taking is one that I'm supposed to be taking than force my trade here on the NASDAQ or S&P 500 and kind of build bad habits. So I'm going to look for a breakout and a pullback. That would be a signal for me to potentially get long NASDAQ or S&P 500. I also do like the Russell a lot. This one has not nearly run as much as the other indices. And so I've actually been trading this one here pretty regularly, actually, with some options trades. Let me show you that. So I've had a position on for a little while on the IWM, which is an ETF that tracks the Russell 2000, and I am currently floating over here. We can zoom in a little bit, a $425 profit. It's not huge, but I've actually shorted puts on this one, which is basically a way of saying, hey, I'll sell a put. If the market drops down here, I will take the assignment and be put the shares essentially. If you're not an options trader, totally understandable. You can look up my videos on the options market stuff if you're interested. Search up TraderNick options strategy if you'd like to learn more. But it's a really kind of nice way to even out some of the P&L of my trading account through selling options on things that I wouldn't mind owning some shares in. So I actually have IWM. Another trade that's actually working quite well for me today is NVIDIA. So I shorted 2 different puts. Both are very nicely in profit right now. I shorted the 110 and 115 puts on NVIDIA, and I also own some shares. I own 100 shares of NVIDIA at an average share price of, well, we can look at it right here, 123, let's call it. So 123.08. So I do have some shares of NVIDIA. I've also shorted puts. This trade's going really well so far, and I'm going to look to probably take some profits on these puts that I've sold. And actually, if we continue to rip higher, I may even sell some calls against my existing 100 shares of NVIDIA. I really like the semiconductor space in general, which is of course an industry in the stock market. Like semiconductors are everything from NVIDIA to AMD, Qualcomm, companies that make computer chips. I like that part of the market quite a bit, and I have for some time, and I actually do continue to have a position in SMH. I'm long 420 shares on this one, and I've got a stop loss below these lows. This trade has bounced back nicely from those deep seek sell-off lows, and I'm up about $3,100 on this trade. Another trade I've been talking about recently is my TLT long position. I have 4,500 shares. I'm currently floating just about break even, up $665 on this trade. Momentum seems to be forming for TLT, and it's a part of the market that I like quite a bit. It's a bit of a defensive play to be long TLT, similar to the Japanese yen. In fact, these two things are highly correlated, as I've been talking about recently in my videos quite a bit. Typically, when yen pairs get weak, like dollar yen, pound yen, CAD yen, etc., that's actually the Japanese yen getting strong. And at the same time, usually the TLT, the bond ETF that I'm trading here, typically also rises. We've seen a little bit of momentum forming here. I am long, like I said, a good bit of a position, and we'll see how that plays out over the next couple days. If we break and lose this momentum, I'm probably going to look to exit the trade. Let's take a look at the put to call ratio also, just to get an idea of market sentiment. So you can see at one point we were incredibly over kind of bullish, right? Everybody extremely greedy. Market sentiment has flipped back a little bit. I wouldn't necessarily say by any means that we're seeing some high extreme level of fear in the market, but we've come down from our optimism a little bit here with the put to call ratio balancing out just a bit. Again, still very bullish overall this market is. However, one thing that is worth mentioning is that the AAII sentiment indicator here, which shows investor sentiment for stock market participants, it's actually reached a high in terms of bearishness. So there is some fear in this market. I think the Trump tariffs and things like that are keeping people a little bit uncertain about this market. Some inflation fears are out there. And with CPI this week, who's to blame investors for getting a little bit more cautious about this market? I mean, we also do see overall a very low level of bullishness. The only lower point on this chart here is back here in mid-January. So we're seeing a little bit of cautiousness in this market. And what that actually signals to me is that if you do get a sell-off, I'd actually buy that dip simply because I like when market participants are a little more fearful. In fact, them being fearful right now could potentially be a bit of a spring unwinding here for higher highs in the S&P 500 and the NASDAQ. But again, like I said, I'm still going to wait for my setup and be patient enough to try and wait for that rather than launch into a trade just because investor sentiment. Just a warning here about investor sentiment. I love sentiment indicators. I track them all the time. Obviously, our tool tracks a whole bunch of things like institutional money through the commitment of traders data, retail positioning, the put to call ratio, investor sentiment. I love these sorts of studies, but we always have to take them with a little bit of a grain of salt, if you will, because again, market participants getting very bearish right here or actually outweighing bulls right now could actually just be the start of bearish sentiment. We could actually see this thing rise as markets get, sold off. So just be aware that sentiment is not always a great timing indicator, but it's a great risk to reward indicator. And that's why I absolutely love using them. As this thing gets more and more bearish, that tells me bullish setups have potentially some good risk to reward to them. Like I said earlier, if you'd like to try out our software tool, the Edge Finder, you can find a link in the description down below to sign up for a trial for 30 days. Please note that trial is not free. It is a $199 payment to try the Edge Finder for 30 days. And that fee, because sometimes people ask why we charge a fee to try out the software, pays for the time of our team who support people through their trials. And we used to offer free trials, and what people were doing was just changing out their email every week to get a new free trial. So they'd get a free trial, and then when that would expire, they would just change their email. So we're smarter than that. We figured out, okay, what we'll do is make it so that it's a small fee and that gets credited towards your final purchase. So if you're a serious buyer of our tool or very interested in trying it and taking it seriously and working with someone on our team, check out the trial link in the description down below. I mentioned a moment ago that this week we have the CPI and PPI numbers. These are key inflation reads and very important to what happens with the dollar, gold, stocks, and everything else. I actually had a conversation with Ivan on our live stream today, and you might find some of this helpful to get ready for this week's key events. This video is also sponsored by DNA Funded, and if you're someone looking to get funded or take a challenge, it might be worth checking them out. The link is in the description down below. They also offer a promo code with us. It's A1T10 to get 10% off any of their challenges. They offer profit sharing up to 90%, unlimited trading days for 1 and 2 phase challenges, and you can trade 800 or even more than that assets in one singular prop firm. Check them out down below. Ivan, talk to me a little bit about this week. We've got a pretty big week in front of us. We've got CPI numbers, the producer price index numbers. Powell is speaking a couple times. You got the sunglasses on. Clearly, it is a big week. That's how I know it's a big week. Is if the sunglasses are on, we got something cooking. So set us up for this week. What are we watching for?
Inflation. Does it go higher? Does it go lower? And I don't think that Trump's kind of impact on the S&P on the inflation is there yet. But I'm definitely watching the dollar index, and has made like a small little bullish attempt to a reversal. So that's what I'm looking at this week.
Okay. Yeah, no, I mean, inflation, the Friday University of Michigan inflation forecast spiked, causing, some dollar strength and some worries in the risk asset department. Do you think that is worth really paying attention to, or is it really just all about CPI this week?
I think it's all what do you call it? It's all a bit of a sum in summarium, if that is even a word in English. It's what do you also we have a bit of issues. I'm just going to find the heat map. So we have quite high relative CPI. We have somehow elevated. Okay, not that much, but still, the NFP on Friday was above 100k. And then you have core CPI, and you have other things that and even manufacturing PMI and services PMI are all above 50. So we still have a lot of bullish, in my view, bullish indicators for continued dollar strength.
Yeah, I mean, that's the thing is this week, and little tricky component of this heat map too is you actually, if you're a dollar bull, you want all of the inflation readings to go red, which would indicate hot inflation. It's a little bit confusing because the heat map is specifically built for like, if you're looking at this and you say, okay, this data going hotter, PPI year over year, core CPI, CPI year over year, core PC. If these numbers came in higher than expected, these would actually turn red, which would be bearish for stocks. That's the way to read that. Is this bearish for stocks, but it would actually be bullish for dollars. So yeah, no, I mean, that's the thing we want to look at here, guys, is this heat map has been changing colors pretty aggressively. We've seen a lot of stuff go from, it was pretty much all blue the other day. And now we've seen GDP numbers kind of slip in. You have services PMI last week was a big miss. Retail sales were also a little, well, they were soft. And then you had jobs numbers came in a little bit light for the headline. We're missing revisions here. I'm considering adding revisions to this page. And then, we have also unemployment claims that was pretty much flat. ADP was a little better than expected. JOLTS was light, but just going through this, you can see it's more of a checkerboard than it was a couple weeks ago. A couple weeks ago, you just had clear dollar dominance. Now you can see the chart has actually reflected this mixed sentiment. We've now just gone sideways, chopping around for the dollar index. So I agree with you. I mean, this week is all about inflation. If you get a really strong inflation number, meaning higher than expected, it could relight the fire here a little bit for the dollar bulls.
Like, also, what I mean, and I have to add that to your analysis is, yes, we have the actual number, so we have the expectation. That's just for that day. That's the burn for that day. But if you go overall, you still have average hourly earnings is about 4%, which is inflationary. You have, for that matter, an employment rate at 4%, which was more people got a bit more jobs. And non-farm payrolls, and the revision was from 256 to 307. So that was a 50k uprise to me, which is bullish. But then this month was only 143, a bit less than expectation. But that's a low number, but still within whatever we have, still within the margins of error as of lately.
Sure. Yeah, no, I mean, that revision on Friday was really worth noting. And a lot of people, there wasn't a ton of coverage on that. A lot of people really quickly focused their attention towards the Michigan stuff, and also the Trump tariffs and the retaliatory tariffs and all that stuff. Everybody kind of very quickly shifted off of jobs. But you made a really good distinction there that I think is important for everybody to recognize. Yes, you missed this red dot, guys. That's your expectations. That's what forecasts were. So yes, we came in light. So you say, oh, we had bad jobs data. But as Ivan just pointed out, this revisions line is very, very important. We revised this number from last period higher. So that gap is actually a bigger gap than this. It's a quick way to read it. We actually had a lot of jobs gain. So, jobs data was pretty strong, I would say. And you also, very importantly, the wage growth. And this is what's moving markets here a lot recently, is the inflation concerns. Well, wage growth in the United States is not falling. It's actually staying very strong. So you're seeing wage growth, which is inflationary because more people getting higher pay. That equates to prices of goods typically rising as well. So You know, we've got a story here this week where if you see a big swing and a miss on inflation data, if you have, you know, CPI and the PPI numbers come in hot, that could easily spook the market going forward. If we take a look at, let's take a look at PPI specifically because it has this cool chart. Last time around, we had a light print, meaning this populates as red. If a number comes in hotter than expected or higher, it comes in blue. If it comes in lower than expected, it comes in red. So last time we missed and the market celebrated that. What happens this week if we resume this trend, which was higher than expected than forecast? So very important to watch to see how that impacts markets this week. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.